Good afternoon and welcome to another Finax podcast. My name is Tamara and this is Shimon.
Hi, everyone. Thanks for joining us today.
Hi, Shimon. Today we are going to discuss a topic that I think is very close to your heart. We are going to talk about investing as a student.
That is close to my heart. That is practically experienced.
What a better person than you to discuss this topic with. I wanted to talk at the beginning about maybe the prejudices that young people have when speaking about investing. A lot of youngsters think that, investing is for older people. I won't say elderly, but for older people. And also another thing they often think is that they need a bigger amount of money in order to start investing. So here we are today, and I want to speak about this kind of prejudices and the ways we can think about them and basically break them, because as we know in investing world, these are not true. And as a matter of fact, starting early in investing is a very important thing. So would you start?
Of course. I would maybe start with the first thing. So one of the prejudices that you mentioned is that that investing is something that adults do or older people do, and while you're young, you should travel and you should enjoy your life and you should worry about retirement later.
You should spend money when you're young.
Yeah. Which I think is a pity, because there's this, narrative going around that investing or beginning to invest in a younger age necessarily means giving up on the joys of life and becoming this boring adult who cares about finance and not being able to travel and not being able to go on vacations, not being able to have coffees, which is not true. I have been investing since the beginning of my studies at the university, and I do go on vacations. I did some traveling. I do go on coffee dates. So all of this is possible.
You look a bit pale though, but it doesn't...
Yeah, that's possible. See, that's the adult part in me.
Yeah.
No, but so I think one of the main reasons, or one of the main things we want to talk about here today, is that the reason why this is especially possible, having been able to invest only a portion of your income and still spend the rest on the joys of life, if you're investing while you're young, is that the sooner you begin with investing, the more money you accumulate, or the less money you need to deposit monthly to arrive at the same result as if you started comparatively much later on in your career, right? So there's this famous analogy or allegory, in the world of finance, which is often being used in this context, is that look at Warren Buffett, such a rich man. Everyone wants to invest. Everyone wants to build wealth like Warren Buffett, the idol. So he bought his first stocks very early in his teenage years. I don't even know if
I think when he was 11, right?
Yeah. So it was even before his teenage years, right? Already when he was 11, and he acquired a lot of stocks already throughout his teenage years and throughout the age that we usually consider to be a student age. And when asked later on in his life what was his biggest investing regret, is that he didn't begin even sooner than the age of 11, which may sound funny. But the reason why this is sensible is due to the effect of compound interest, right? So due to the effect of compound interest, which you might have heard of, the sooner you begin, the stronger this effect is, and the stronger it starts multiplying your wealth. So maybe it's just so I don't spend this entire podcast talking.
No, I just thinking maybe to mention here, maybe people are more familiar with the compound interest working against them. For example, when they have loans.
Yeah.
So they know how dangerous it can be. And basically investing and starting early is something that can turn it around. So this time it can actually work for you.
Exactly. So the analogy I like to use to describe how it works is sort of like a snowball rolling down the hill, right? So at first, when it does one rotation, it increases only slightly, right? Because the surface area is smaller. So it needs more rotations to double in size, let's say. But the larger it is, the faster it rolls and the larger its surface area. So one roll creates or pushes more snow onto it and makes it, expands its area by a larger absolute amount measured in, say cubic centimeters of snow or whatever you take to measure it. And this is similar with investing. So when you invest, how you should do it, and as we discuss in our other podcasts or in our blog, which you can check out, is that you should invest in the global economy. So not speculate about which stocks will be the next Bitcoin or be the next Nvidia, but sort of hold the global economy. Yeah. So that you can participate in the growth of global economy. And there's this mathematical expression, I'm sorry for making it a bit technical, but there's this expression you might hear that the global economy doesn't grow linearly, but it grows exponentially. What does this mean? Simply put, it means that if the global economy grows, or the global stock markets and their value grows by 8% in 1 year, their value expands to a larger base. And if then it grows by further 8% in next year, this growth isn't applied to the original base, so it doesn't grow by the same absolute amount of dollars or of euros each year, but it's applied already to the larger base, to the base that was created at the end of year one, right? At the end of the growth. So the marginal amount of extra euros that sort of appear in your bank account as a result of economic growth, as a result of stock market growth, will be gradually increasing as you let the money work for longer and longer. So while during your first years, you might get 100 or let's say 80 or similar amounts of euros as your investment return, when you've been investing for 40 years, the single year growth or the single year increase in your wealth might be in thousands, might be even in tens of thousands of euros. So you will make much bigger steps if you invest for the long term. Is there anything you would like to add about this?
No, I'm just thinking, not to forget about the fact that we said, I want to kind of make a few points about the whole importance and maybe the steps one should take and what they need to think about. Because for somebody who is really not from financial world, it might be quite confusing in early days. But yeah, I just want to go back also to the fact, as we said, nowadays you don't really need a lot of money to start investing, even in such diversified portfolios like you mentioned. So, for example, you can start investing from 10 euros a month, which is, I think, something that pretty much everyone can afford nowadays. And it might be also an opportunity for you if you have some kind of fear or you're reluctant to start for some reason. If you just put 10 euros monthly, you can see in a few months how you feel and basically how it works, right?
Exactly. I actually ran some calculations before coming to this podcast because we can sort of model how a very long run investment would develop, assuming some appreciation, some growth rate of the global stock markets. And there's this magic number that is often used in the world of finance, and that is that over very long years of data, more than 100 years of data, there has been a tendency in long-term investing, so one that is for decades. We're not talking about months, we're not talking about years, we're talking about decades, lifelong investing. The global stock markets had a tendency to grow at a rate of approximately 8 to 10% per year. That's a very long-term average. So you take 30 years of investing.
This is including all the wars and everything else.
Exactly, including all the economic crises, including 2008, including the collapse of Enron, everything bad that you can think of, right? So you're left with 8 to 10% when you take the yearly average over a very long period. And that has been a pretty consistent number over the history that we've been able to record. So it's often used in these forecasts. And so I ran some calculations. If you invested for, decades with achieving an average 8% annual return over this very long period, and already when you invest 50 euros a month, right? That's not, especially given that we're talking about lifelong investing. So you can probably over the course of your life find 50 euros somewhere and it is possible to invest very efficiently already from this amount. So if you do this for 30 years, that is, let's say you start at 25 or even 20 when you're still at a university, when you're still studying, and you do it for 30 years, so until you're 50 or 55, that's even way before retirement. That's when you have kids. That's when you can, that's when you need a lot of money to secure yourself and to secure your loved ones. So if you just do 50 euros with this, assuming this return for 30 years, you will end up with almost 68,000 euros in your investment account. That's from 50 euros a month. That for many people is an insanely high amount of money, especially given that many people then can later invest even more as their income grows, right? When you stretch it to 40 years, it becomes a staggering 155,000 euros from just 50 euros a month. That's unimaginable for the human mind because, the snowball effect of compound interest is counterintuitive, but such huge amounts that in our minds often are tied to millionaires, to people who have successful businesses or mega successful careers. You can get to these amounts even for something that the average person can do, that an average student who doesn't have a lot of money can do by adjusting the budget, by working a part-time job, and by setting aside this amount each month. In contrast, if you delay this decision, right? So let's say you start investing when you're 40 and you invest only for 10 years until you're 50, assuming exactly the same assumptions, the same growth of the stock market, the same monthly investment, you will get to only 8,700 euros over those 10 years. That is incredibly lower compared to the 68,000 or 155,000 that we talked about with 30 years. And it's the same monthly investment, it's the same return. The only thing that changed is that you started and let your money work for longer in one of those cases. So actually starting sooner can be the difference maker. It can be the difference maker that, that will earn you such a huge difference of money as if you were a super successful investor, as if you were very good at selecting, successful stocks or something. So really one of the easiest things that you can do to be super wealthy is start early and let the compound interest actually do its magic over the 30 or 40 years of your productive life, right?
Yes, I think another motivational point in this podcast should definitely be demographics and basically the unfortunate trends that we have in Europe and in some other regions as well. But now we are talking about Europe because that's where we are and where our interests are. So it is, I know you have some numbers for us as well on this topic, but I just wanted to say that no matter where we go in Europe, the trend is basically the same. The numbers might vary a little to an extent, for example, like Croatia, which has one working person, 1.14 working persons on one retired person. So it is inevitable that the system is very much, I would say, spread to its limits when it comes to government securing the pensions. And it's creating, obviously, problems with the taxations and where the money needs to come to, to budget the whole retirement system in Croatia, for example. But as I say, there are many other countries who have similar numbers. So let's look at these numbers and basically talk about the fact that, retirement problem is not just a current problem, but it's going to be even a bigger problem, for example, when your generation comes to the point of retirement.
These won't be good numbers to look at, right? But we have to face the reality.
But it's important to raise awareness because I think when I think of my student days, it wasn't something we were thinking about. So like
I
you
still
were mentioning earlier, most of the people think, oh, I'm just starting my life now. I want to enjoy, let's have fun, all these kind of things. You don't want to deal with this kind of problems of the existence, and what later life might bring to you. You just want to have this freedom of doing whatever you want.
But, and you can still have that alongside investing.
Yes,
right?
Yes. But I think it's really important, and this is why we're doing this podcast, to raise the awareness about the necessity of starting to think about it and to basically break these prejudices that it's impossible because somebody is not earning money constantly, but for example, just has some, gigs here and there, and other than that, it's not earning money. But nowadays, this kind of thing is really not something that should stop you from investing and from saving for a better future.
Yes, definitely. So let's look at the data, because as you said, I also did some reading on this. So the sad fact that we cannot deny is that the European Union's and the entire Europe's population is rapidly aging. The median age in the EU was 44.4 years in 2022, which was an increase of almost 3 years from 2012. So, 3 years increase in the median age over a 10-year period. That is rapid. Just imagine where it can get until 2050, where, let me provide a background to this other number, right? So the reason why that is a problem is that the crux of the current Europe's pension system is the so-called pay-as-you-go national schemes. What does that mean? That means that the government has an agency, some social insurance company or something similar to that raises taxes or raises money from the people who are currently working, so people who are in the productive age, people who are working age people population, and just takes their money and right away in the next month distributes that money as pension income to people who are already retired, who are entitled to the state pension. This can work well as long as you are capable of raising enough money from the working age population to distribute it to the retirees. It starts being a bigger problem if your working age population, so people who are earning some income that can be taxed, is shrinking, whereas the number of people who are retired is expanding rapidly. And that is happening due to reasons such as better healthcare and longer life expectancy, but also due to reasons such as rapidly decreasing fertility rates and young couples having fewer kids or being unable to have kids in some cases. So you think of or being unwilling to have more kids due to money reasons and stuff like that. Due to these developments, super low fertility rates, longer life expectancies, the number of working age people, so people who are creating some money that can be used or raised via taxes and paid on pensions, is rapidly declining. We have fewer and fewer working people per one pensioner who needs income, right? In 2021, this is 2.9, and in 2050, which will be when many of members of my generation won't still be retiring, so we need something even further in the future, it will be just 1.8. So from 2.9 working age people per one pensioner to 1.8, a decline by more than one person. And that is bad because that will mean that state budgets will come under pressure. And already now standing in 2024, they don't have much flexibility in terms of the capability to just suddenly get more money from debt or something. It already costs 10% of the entire EU's GDP to cover pensions, and the European Union's debt to GDP, so how much debt we already have compared to how much we produce to pay off that debt and to service that debt, is already above 85%, which is relatively large. That can increase to some extent, but not much. Countries such as Greece taught us that even in the developed world, you cannot stretch the boundaries of state debt to infinity, because at some point it explodes and it harms everyone in the state. It harms everyone in the continent. So the reality is that in the future, because there will be less money and more people in need of pension income, pensions will very likely first be increasing at a lower rate than inflation, and then maybe even be decreasing or stay at the constant level because we just won't have enough money to cover them. So in terms of what portion of your working life income the state pension will be capable of replacing, it will be a very low fraction. Estimates range in different states, but it's often around 1/3. So can you imagine cutting 2/3 of your expenses from day to day?
It is already like that in some of the countries.
Yeah, exactly. Already now. So it can be even worse. So can you imagine cutting 2/3 of your expenses from day to day?
What it means to your lifestyle and everything else. Yes.
Yeah.
It's very sad actually, because we are actually, I think throughout the life we envision pensionists as somebody as people who are free. They don't need to do anything. They can enjoy their lives, right? But then, yes, travel. So I think from that perspective, we see that that's not what future holds for us unless we start doing something about that. Basically, the whole point here is that we need to take this into our own hands and start taking care of our financial future, because it is very hard to depend just on the governments and on what the future holds. As we see, the systems at the moment are really not going to fulfill their main goal. And I think it depends a lot also on the politicians, how much they're going to be willing to admit it in order to take some major steps, to do some changes. So it's always politically difficult decision to make, because one who is in charge now would like to stay in charge. And when they make unpopular cuts or changes, then they tend basically to lose next elections. But looking from our perspective as an individual, we just need to basically be aware of what's going on and start to think about how we can help ourselves, right? And this is, as we said also at the beginning, there is no more reasons why not to invest. There is basically this necessity nowadays to invest, because we cannot just put our money in the banks and expect very high interest rates and stuff like that. So basically, in order to secure our future, we need to start saving. We need to basically start investing as early as possible in order to provide ourselves with a better financial future. So this is why today we want to talk about that. And as you mentioned, the compound interest is really important. And we said that even investing from small amounts of money today is also something that everyone can do into very diversified portfolio. So what I'm trying to say now is that people don't need to be afraid if they don't have any knowledge about finance and investing. Nowadays, there are robo-advisors, there are many platforms and ways to invest without a huge knowledge about investing, which is also good. I want to mention that knowing some basics is always important. It's really important to know into what you are investing, what kind of tools you're using, and some basics like what are stocks, what are bonds, and you need to, in a way, pick what is good for you. And in order to do that, to do a quality decision, to make a quality decision, you need to have some basics. But as you mentioned earlier, nowadays everything is easily accessible, and the knowledge can be learned for free on the web. So that's not something also that should be something holding you back from.
For sure. Definitely. That is the reason why we as Finax are doing these educational podcasts and articles and on our website. So definitely, if you're completely new, I would for sure recommend to at least listen to our other podcasts, read some of our blogs, and also read other sources, right? Inform yourself about what risks are inherent in investing and so on, because it's important. And that's also the reason why we do this education. You cannot be a truly good investor if you don't have sufficient knowledge of the true risks involved and of how investments behave, because and that is, I think, also one of the amazing reasons why people should try investing already with smaller amounts of money when they're younger. It's that when you invest in the global economy, when you invest in ETFs, which we repeatedly said in videos, think are the best way to invest for average people. When you invest in them, the global economy is not going to grow constantly. So we mentioned some 8% and stuff like that. The stock market almost never grows by exactly 8% per year. It can grow by 35% in one year and then decline by a half in the other. So there will be, and it can also grow by 0.5%. It can, the dispersion of each year's growth will be very wide.
And the volatility will always be present.
There will be swings and there will be declines. If you invest for decades, you can count on there being several major declines in the value of your investment account over your life. That will happen, period. There's just no way to avoid it.
And you need to be prepared for that, exactly. But also maybe to mention here the difference between investing and speculation.
That's what I wanted to get to.
Yes.
Exactly.
So go ahead.
When you're investing, that is, you hold the global economy, you participate in the value of the global stock market, you can be almost sure, or at least it has never happened in history, that over lifelong periods, such as 30 years or 20 years, you wouldn't profit on the investment. That's because humanity advances in the long run. We create new inventions that enable companies to be more productive, that enable humans to be more productive. We make people more educative and having higher skills even in poor regions. We constantly seek healthcare innovations, scientific innovations, and sort of that is why the productivity and the wealth of the global economy is growing. And if you own the stock market, you will profit from that long-term global growth. So investing for a lifetime means that you're making a bet that the global economy will be further than it's today in 30 years. Which is a much safer bet than some other bets we will be talking about today, right? But it won't be a constant growth. There are economic crises, there are declines. The stock market can decline by 20, 30, 40%. That has happened in the history. So you need to be prepared for those declines. However, if you're investing for the long term, these declines, even if they're for a couple of years, shouldn't really worry you much, right? Because essentially all of the declines that happened in the history of humanity and in the history of global stock markets has been recovered eventually, because humanity is adaptable. We are capable of creating solutions to crises. Oftentimes crises even lead to new inventions and lead to advancement of our humankind, right? So all the crises in history have been recovered from, and the stock market continued growing after that period. But that period of a decline can last even for a couple of years. That will happen. That will for sure happen when you're investing. And so what happens when you start earlier, in a young age, with smaller amounts of money, when you have less to lose, right? You have lower stakes. You don't have people who depend on you. You don't have a mortgage or debts to pay off. That is when you can safely learn about how the dynamics of the stock market works without being so prone to panicking, right? Because the worst that you can do in investing is there comes a decline and you sell for cheap prices, realize the loss, and then the stock market rises again. You're not in it anymore, so you don't benefit from the market recovery, which is often most of the returns, and you just are left with the loss and frustration and fear of investing forever. You should do the opposite. When declines happen and stocks are cheap, you should buy in, because that's like discounts in stores, right? That is when you can get a share in the global economy for cheaper prices relative to your entire life, right? But panic selling and realizing losses and then missing out on returns, that's what usually happens. And when you're young, you sort of are less prone to panic, exactly for the reasons I mentioned. And that means that over your student years, while you're having lower commitments and lower amount of money, you can learn what is normal in the stock market. You will survive a decline that will last for maybe a couple of years. You will survive the daily volatility. You will see that often returns occur over a short period. You will learn about these dynamics, and that will be very valuable when you will have more, to lose in your life, when you will already have people who depend on you, when you will have large wealth and you will have to manage that large wealth wisely, when you will have maybe a mortgage and you will have to be smart about being safe with your finances. You will already know these things, and you will be less prone to panics because you will know how the stock markets tend to behave. And that is a huge asset. That is hands-on experience with how the market plays with your psychology is extremely valuable. I'm talking from my own experience because, I started investing in around June, July 2021, right? When I joined Finax, that's when I started investing, passively, so into the global market for the long run. And essentially, during the first couple of months, markets were growing rapidly. I thought I was super skilled and everything was nice. And then a bear market came. And for 2 years, there were declines in my portfolio. It took almost 2 years for it to recover from red numbers. And it was stressful, but it recovered. And it is growing rapidly now because, again, recoveries often happen rapidly. And now I am more experienced, and future declines won't be that psychologically hard to bear due to this experience. And I think learning this while you have less to lose is extremely valuable.
It is scientifically proven that people tend to react much more on losing 100 euros than on gaining 100 euros. So while you invest as a student and you don't have as much money on your account, it is a good way for you to learn. First time you see the numbers in red, how to deal with emotions in order to actually prevent yourself from having emotional reaction on that. As we say, emotions are the biggest enemy of investing, and it's a good way to learn because, talking about it, even knowing it, it's one thing, but actually experiencing it is a completely different thing when it happens.
Experiencing the emotion that you experience while
so
your portfolio
whoever tells you that there is some kind of investment without risk is not telling you truth, because volatility is normal on the stock market, but as you said, over a long period we know that economies grow, people go further and further, and eventually bear markets change to bull markets, and then we all feel happy and see our accounts in green. I think one of the main points we wanted to say here is that it is very important to know your investments, so to know what you can expect, to see maybe some predictions, what they are based on, to differentiate investing from speculation, and to make sure that once you decide to invest, that you invest via some licensed provider or broker, because there are in financial world there are things which are more regulated, and there are things which are less regulated. So from that perspective, it's also important to know where you are putting your money. Otherwise, it could happen that because you were not informed well, you make a bad decision, and then basically it stops you from investing in the future, which would be really sad.
That I think is a very important point, and it ties more generally with the speculation point, which I would like to develop a bit more as we wanted to come back to it a bit earlier. So the license of a broker or of a banking institution or of an asset manager is extremely important. It comes in waves, and there has been a history of these shady institutions just wasting people's lifelong savings because they were not regulated and they were taking risks that they shouldn't have with that money. I remember that in Central Europe, there was this wave of non-banking institutions that were offering various high-interest savings accounts, and then many of them turned out to be a scam and a tunneling scheme, and people never got their money. But more recently, we had this trend of cryptocurrency investing via various shady crypto hedge funds or crypto banks which offered super high interest rates on their bank accounts and promised them to be relatively risk-free, although they were lending the money elsewhere and playing around with super volatile, super dangerous instruments. And I know many of my friends personally who lost thousands of euros by the bankruptcies of these institutions that we've seen over the past 2 years, or by some of the accounts just turning out to be scams. So be really careful about that. But that ties more generally with speculation and with the desire to look for shortcuts, with the desire to get rich quicker than others and sort of make it a race.
So, there are no shortcuts, and whoever tells you something
also
else
it's not a race, right? This is not a competition. Personal finance is a highly individual field. You are building wealth so that you can provide yourself and your loved ones with freedom and with opportunities to do whatever you as a group like. And that is not a zero-sum game. You don't have to have more money than your neighbor to achieve those financial goals. Everyone has different financial goals. So don't make it into a race, because then the need, because yes, we told you about the process of decades-long investing, lifelong investing. You make the 50 euros a month a habit, right? And you forget about it. And then in 30 years, you wake up to hundreds of thousands of euros in your bank account, in your investment account, not in the bank. Don't invest in the bank. But that is a boring process. That is a super boring process. That's the beauty of it. You can forget about it and go on with whatever you like more than numbers and mathematics, which I'm sure for most of the listeners is actually things they love more. No one likes to look at numbers and charts and percentages and maps and math all the time. So that will be even more pleasant. But it's a boring process. There's nothing super sophisticated to it, and you have to be super patient. It's for decades. You just have to be patient. You have to be you have to believe in what you're doing and not compare yourselves to others. But especially as young people, we often have this energy, this competitiveness inherent to us, which is great in career, in studies, in everything where being like this can lead you or can help you immensely. However, in investing, that usually leads to taking risks that will end up going against you, right? So what I mean by this means picking stocks and thinking that you can select the ones that will grow faster than the market. Or this means using leverage and borrowing funds to invest, to boost your returns because you believe you will be successful in these investments. Or it's selecting some other asset classes such as cryptocurrencies because you've seen them growing for the past 3 years and everyone around you is doing it, so it must be a great investment. The thing is, usually no one can predict the future, and most of these decisions are taken based on past performance. And think about it. When you're selecting stocks or picking individual assets or speculating, you are betting that you have somehow superior information about how the world will develop compared to all the hedge funds manager at Wall Street who have supercomputers and databases that cost $3,000 a month. I don't think you are going to rationally know something that they haven't figured out years ago.
It's not included in the price already.
Yeah, and it's included in the price, which means that basically you're just making the investment based on a feeling, based on an emotion, based on an irrational expectation, and that is essentially a bet. That is like coming to a casino and making a bet because there's some chance it will turn out correct, but also incorrect, right? And people who do this often end up losing money because they want to take more risk to increase their returns, and the risk will realize into them losing money, such as when cryptocurrency platforms went bankrupt and many young people lost thousands of euros of savings. Or it means that you will, or look at, the statistics that brokerage companies have to state that most of the accounts of their retail clients are actually at a loss. Or if it's not most, then it's a substantial percentage. Because when you trade super risky instruments like options or like stocks frequently, you will incur trading costs and you will make wrong bets many times, and that can accumulate into losses. Or they achieve some returns, but they lag the market. We think that is risky. That can cost you a lot. no one from their couch is going to have better information and better forecasts of future prices compared to professionals who are going against you in this game. So the best you can do is to just hold the global economy, participate in the global growth. That still is a lot of returns. We told you the numbers, 50 euros a month, resulting in more than 100,000 euros if you do it sufficiently long. And if you want to increase your wealth, if you want to take a more calculated shortcut, let's say, then invest into yourself and your career and increase your lifelong income and increase your savings rate and invest more into the growth of the global economy. And that many times will lead you to much more certain, much less risky outcome, an outcome that doesn't bear such a great risk of you losing everything in an instant, than taking on loans to invest or then trading some risky instruments.
If I may, we constantly basically support and motivate people to invest passively, because we know that the statistics show that over 90% of active investors, meaning professional investors who are actually living this, do not overperform market in the long run. So, thinking that you are going to be the one who is going to beat the market is a little bit unrealistic, I would say. But there is also something I want to add on the whole risk thing and topic in investment. There is a really, I would say, important part of your whole investing process to get to know your risk level and risk profile.
Yes.
Platforms like, for example, Finax, robo-advisors, have this onboarding process, which includes questions about your risk profile. It is really important to be honest with yourself when you are answering questions like that, because this way, platform or algorithm can prepare optimized portfolio, optimized strategy for your needs and for your current situation. Situation can always change, right? Because as the time goes, you earn more money, things change and you can adjust your strategy. But from perspective of education, experience, and everything else, especially at the beginning, it is important that you have a strategy which is really optimized to your level. Why? You mentioned it in one sentence briefly, because you need to feel comfortable with your investment. In case you don't, at the time of crisis, when the markets drop, you are probably going to feel uncomfortable enough to withdraw the money and basically to ruin your long-term investment. When we talk about investing for pension, for example, imagine you have this goal and you committed that you are going to invest for 30 years in order to have numbers that Shimon was talking about. But then suddenly, because you heard that it's really good to have a very dynamic portfolio, there is volatility in the market and you see suddenly your portfolio in red. Like, for example, during COVID, it all happened very rapidly, right? And there was like minus 34%,
Yeah. In a month.
And people who were not ready and who were not prepared and who were not educated and who were not experienced enough were pushed to the point where they say, oh, wow, better save whatever's left, right? And they took the money out of the market and the market started going back very quickly afterwards. And
that was a massive run. If you missed out on the period from April 2020 until December 2021, you lost 5 years of returns, essentially.
But, there were many
up
people who, for example, start investing over counter in some banks because somebody just tells them to invest in some kind of a fund because they need to sell it or whatever. And these people were not prepared. They were not educated to understand that, these things happen and it's a normal cycle, right? Nobody has experienced COVID crisis before. Maybe in 10 years, we are going to have something that at the moment we cannot even
we for sure will.
Yes,
that's how
right?
it just is.
So it happens, but even during the world wars and stuff like that, the markets were still doing what they were doing. They were maybe in red, in minuses or whatever, but then afterwards, the whole thing went pretty quickly up. So
the 8% per year. Oh, sorry.
Yes.
I just wanted to say that the 8% per year calculated over the more than 100 history that I was mentioning.
That's what I said earlier. It's also including crises like that. So
that
not
includes
just
oil
COVID.
crises, wars, that includes fallout of the global financial system, everything bad that you can imagine, pandemics, right?
Yeah, bubble.com and stuff like that, right? So everything is in. So this is what we have to know, that eventually, we produce and we as a humanity always strive to go forward. And it's, I think, the only direction we are going. So over a long run, we know pretty much where we are going. So that's, I think, something that is a key also to take away today, that when talking about knowing your investment, you also have to be very honest with yourself. What is your risk level? What is your knowledge? And try to be honest and basically create portfolio you're comfortable with. Over the time, when your experience, gets bigger, when your knowledge gets bigger and everything else, you can always adjust your strategy. You can open more accounts, you can play with it, and you will see that it was worth, doing it the way you were doing it, just for the sake of learning and experiencing the whole thing. So that's definitely a good way to go. Where
exactly.
to start?
I would just maybe add one last thing here, that if you want to get started on this journey, Finax is here to help you. Essentially, that's exactly what our core service does. We have a robo-advisory algorithm, so you just select your goal, you answer a couple of questions about the horizon for which you can, or the number of years for which you can tie the money up, the target, the source of income, your relationship to investment risk, experience, and based on that, the algorithm will recommend a portfolio with the ideal risk profile for you. The risk profile is changed by changing ratios between stocks and bonds. That is not important now. That is discussed in our other content, but that's also the thing. So the robo-advisor helps you select the portfolio, helps you adjust it later on as your goals change in your life. You can open other accounts. And during that, you will regularly receive push notifications for articles and podcasts such as this one, where you can gradually educate yourself and learn more data, learn more facts, and learn about experience of other people who have been investing for decades, to sort of become better educated about it. So we're also here, or mainly here, to help you with the education part. So if you want to, we would be happy if you subscribed, and if you also checked out our other podcasts where we discuss various topics from personal finance, but also introduce our services for those who would be interested and who would think that they would help them in their lives.
There's plenty of content available also to help you decide where to invest, how much to invest, depending on your current situation, and basically learn these basics in order to get you started. We mentioned at the beginning the importance of diversification. This is something that you shouldn't forget. Shimon was talking about that when we're talking about world economics. So it means that we are not going for some super popular region at the moment or something like that, because we know that the balance in the world can easily change, and it's good to diversify your portfolio, like it is good to diversify your investments. You're not going to maybe invest your emergency fund or financial reserve the same way you're going to invest your long-term goals,
retirement savings,
for example, pension, right? So there are different dynamics you're going to use, and it's really important that you know that. And these kind of platforms can do this optimization for you and can help you realize, if I put this amount of money over this period, it's good to go more conservative because I only have a short investing period in front of me. In case of pension, you have a very long run ahead of you, hopefully, and it will mean that you can go much more dynamic with your portfolio.
Exactly.
Also, as we said, you need to understand the risks of every investment. They are different. The more dynamic you are, often it means the more risk you're taking. If you're going for some kind of very conservative products, like, for example, now that we are trying to explain some things, like, for example, smart deposit that we have, it's a product that is really intended for a very, very short period of time for the money.
Like a
that,
savings
for
account.
example, yes, like you saving account, but with better rates than the usual one.
Much better.
So, when you start thinking of how to work with your money, it is important that you understand that, you have some short-term goals and then you have some long-term goals. Nothing beats experience. So start as early as you can and learn while you are young, make mistakes while you are young, and basically work on your better financial future in a long run. Thank you, Shimon, for joining me today again.
Thanks for having me here. And thanks to the audience for listening today.
Yes, and thank you for watching us. As mentioned earlier, try to subscribe to our social media and our YouTube channel, and hope to see you soon again.
See you. Thanks for listening.
Bye.
Bye.